Hello, everybody, and welcome back. There are currently several reasons to take a closer look at emerging markets debt again. But the choice of emerging markets investments may look different today than it did 3 years ago. So I'm pleased to welcome our special guest today, Robert Simpson, co-head emerging markets hard currency debt at Pictet Asset Management. A warm welcome, Robert.
Good afternoon.
Robert, inflation in the US and Europe remains high. Interest rates continue to rise. So, are emerging markets coping better with the current environment?
Yes, indeed they are. And I think there's a number of reasons to explain that. And I think one of the chief amongst them is that this cycle, emerging markets displayed much more orthodox policymaking than developed markets did. They did less QE during the COVID crisis, and they normalized policy much more quickly. If we take Brazil as an example, Brazil moved rates from 2% in March of 2021 up to 13.75% by August of 2022. So they started their cycle at least a year ahead of the Fed. This is important because it's provided a real anchor for inflation expectations. It provided an anchor for currency stability. It's actually allowed inflation to normalize more quickly in emerging markets than to normalize the policy rate the other way, ahead of developed world. Another additional factor is that emerging market local currency markets have remained very underinvested for a long period of time. So despite some external headwinds, the stampede for outflows from these asset classes has been much lower than it may have been in the past.
Many emerging markets are heavily dependent on the US dollar. So, what are your expectations for the US dollar and the impact on emerging markets looking forward?
Yeah, I think it's important to recognize that emerging markets remain a very diversified asset class. And while some countries will be exposed to the dollar, a much broader subset of countries are less exposed than they may have been in the past. But of course, a stronger dollar can impact on emerging market currencies. That can bring a challenge where there's a heavy reliance on dollar financing in those countries, but can also put some upward pressure on inflation. But as a whole, we see an emerging market complex that has become less reliant on dollar funding as it was maybe 20 or 30 years ago. The local market complex has become more developed, and mainstream emerging markets can financing in their own markets versus the international markets, where the dollar becomes more important. That's true not only for sovereigns, but even for corporates. We've seen in the last 12 months or so that even in Brazil, for example, corporates are financing locally at a far more attractive rate than they are doing in the dollar markets once they swap that funding back. So that is a real kind of key anchor of stability for emerging markets, both for sovereigns and for corporates.
Emerging markets are still seen as dependent on commodity exports. So, what is the case for emerging markets investment, especially in the light of the current weak global growth expectations?
Yeah, absolutely. I think the reliance on commodities for emerging markets is perhaps another old story that needs to be debunked a little bit. While it's true there are pockets of emerging markets that are heavily exposed to the commodities as part of their key exports, a huge part of the emerging market complex are also commodity importers. And that matters in terms of the benefits of diversification as we look across the asset class. When we think about potentially the implications of the weaker growth cycle as we hit the peak cycle in the developed world and growth starts to fall, what does that mean for emerging markets? I think cyclically, the global cycle is peaking and we will start to slow down. That obviously will go hand in hand with a peak in the interest rate cycle, and we also think a peak in the dollar cycle. And that will ease some of the external pressure on the emerging market complex. But away from some cyclical factors, there are many key structural factors that are actually really underpinning emerging markets in this cycle. We've seen a decoupling from broad emerging market growth away from DM, but also importantly, away from China, as some of the structural factors of investment into key parts of emerging markets away from China are actually underpinning growth in these countries. We would highlight particularly Mexico, India, Indonesia as some key winners in this context.
Well, you already mentioned the big elephant in the room. So international investors have pulled a lot of capital out of China, not least because of Chinese politics. So is China still investable?
I think, yes, China is still investable. I mean, China has always been investable. But to invest in China, you've always had to really be very selective in terms of what assets you invest in. That's true in equities as much as it is in fixed income. And we've seen this dynamic in play for at least 10 to 20 years. There's nothing new there. But increasingly, as we've seen rising political risks, both domestically and geopolitically in the international arena, the international investor has to be more careful in terms of its investments into China. Obviously, we've seen the volatility in the real estate space, but before that, we obviously had some clampdown on the private sector in terms of the Chinese economy. That matters because the Chinese economy needs the private sector to invest. It's the most productive part of the economy. As Chinese population, the working age population peaks and starts to fall, it will need a rise in productivity in order to maintain attractive growth rates. So that will be increasingly important. So political risk cannot be understated at all, but it does remain investable.
So currently no discussion about China without mentioning the property sector. So the real estate crisis is crippling the Chinese economy, has a deep impact. So what impact will this have on the Chinese and Asian bond markets?
Well, the impact of the Chinese real estate, as we know, has been very key for the Chinese economy, but also the broader Asian and global economy for a number of years now. There was this very strong cyclical tailwind that persisted for at least a couple of decades in terms of demand for commodities, the knock-on effect of demand for other goods and services within the Chinese economy. So the fact that now the real estate market in China is facing some significant downward pressure will have very real implications for the Chinese economy and the broader demand impulse across the region and across the world. The first thing to say, it will be profoundly disinflationary to offset maybe some other global structurally inflationary pressures that we have. The demand for commodities from China related to real estate cannot be overstated. 50% of global copper demand comes from China, even higher in iron ore and other commodities. So there will be a disinflationary impact from a reduction in demand from those. There'll be a broader impact on demand related to real estate investment, related to real estate purchases that also has a very strong impulse for growth in China. So that will put downward pressure on growth and inflation for the economy, but also in terms of how that demand propagates through the rest of the world. I think there's another key impact here, not only with the structural slowdown in China, but also what that means for capital flows within emerging markets. I think we've seen in the last decade or so that much of the demand or much of the flow of investment into emerging markets has gone to China, and China dedicated exposures. We actually think that can rotate out of China into other markets, the broader global emerging market complex, but also some of those key countries that are now stand to benefit from this kind of new world order, if you like. Indonesia, India, Mexico, to name a few.
This leads directly into the next question here. So the aversion to China is putting the spotlight on other emerging markets. So how interesting are younger fixed income markets like India or Indonesia, or the classic Latin America, for example, in the current situation?
Yeah, it's a fascinating time. And I think we are seeing some major structural shifts in the global economy. Of course, we have the shift to clean energy and green energy and the implications of that. But we also have some profound shifts in terms of the global supply chain structure. The move away from the reliance of a single provider, i.e. China, away to a diversification of that risk away from that single country. And we are seeing some significant investment go into some countries that stand to benefit from that. I think the key ones are Mexico and India, and also Indonesia and some other markets. For example, Mexico has seen a significant amount of investment in its border regions in productive capacity, not only from US companies, but also from Chinese companies who are looking to take their own production out of China, but to invest in how the new structure will work in terms of the global supply chain. India remains a fascinating one. I think it's well advertised how production is slowly moving to India away from China for some key goods. And the bond market is internationalizing as well. It's just been announced that the Indian bond market, the local currency bond market, will join the JP Morgan, the main global index for emerging market local markets. So we think India will structurally benefit from capital reallocation, not only in fixed income markets, but also in equity markets. And that's kind of well underway from international investors.
In terms of allocation, quality, and maturity, so where is currently the sweet spot for an emerging markets debt investor like you are?
No, absolutely. We're very lucky as emerging market investors to be able to benefit from such a rich and diversified and global opportunity set across local markets, across hard currency assets within sovereigns and corporates. At this stage in the cycle, we think there are a lot of opportunities in shorter dated assets. We think we're at the peak in the global interest rate cycle. And the rates available in shorter dated assets are very, very attractive. We also think the yields available across the entire emerging market complex should actually start to pique investors' interest. And it remains a very interesting stage in the cycle to be able to lock in all-in yields at a level we haven't seen for a very long period of time. But cyclically, as we enter into a stage of slowdown for shorter dated assets, and also very selected high yield opportunities within sovereign, where we see some significant upside from recovery after going through a default scenario. But as these situations normalize and they come out of default, there's a very strong upside. I'm thinking of countries like Zambia, Ghana, or even Sri Lanka that are nearing agreements with international creditors to come out of that default scenario into normalization.
So this was Robert Simpson from Pictet Asset Management. Robert, thank you very much for being with us today and sharing your insights on emerging markets.
Pleasure. Thank you.